Welcome to another Straight Up Tuesday tip. I'm Tom Shellcross. With me as always is Mark Ainley, and with us again, Chris Pulio. Welcome back.
Thank you. Thanks for having me.
For our listeners, they know we recorded 2 in a row. We're wearing the same stuff. We don't have to put on it. We can get past the shenanigans.
The funny thing is you actually suggested that we change shirts.
We have recorded after this. I'm changing a shirt. You guys, for our YouTube listeners, you can figure out what episodes we're all done on this Friday.
All right.
All right. So, Chris, this has come up a few times now. We have a lot of our listeners who they've house hacked. They've house hacked 2 or 3, 4 different times. You know, they're getting to an age, they're having kids or whatever. They don't want to live, you know, in a 2-bed, 1-bath apartment. They buy a single family residence. They want to keep buying investment properties. This is their first time that they want to buy a 4-unit. They know they're not going to live in it. Mm-hmm. Right? It's first time non-owner occupied investment. We never really cover what are the loan options there? Because we talk about all the 5% down, all those great ones. But now that you're non-owner occupied, can you walk us through terms, rates, and options that they may be looking at?
Absolutely. So outside when you're going non-owner occupied, you have your conventional Fannie Mae, Freddie Mac products, which are different down payment requirements between 2-unit and 3 and 4-unit. Okay. 3 and 4-unit are going to require 25% down. 2-unit, you can go a little bit less. So it does require a larger down payment. The great thing is you didn't spend all your cash when you house hacked because you went in owner occupied on the first one, right? Much like we talk about the long-term vision of investors. Even if you have $100,000 and you're willing to house hack and live in that property for a year, save that cash, put it on the side for that second, third, and fourth property. So if you qualify, the great thing is if you own a multi-unit now, you're already, in Fannie and Freddie's eyes, a landlord. Right? You have that reporting on your tax return. So you can use those future rents to qualify on the property you are buying. A lot of times that's enough right there to get somebody to be able to buy the new home. So it's really going to be about the down payment. Where are you getting that down payment from? Okay. Some people are borrowing that money from 401k. Some people have that cash liquid. I always say, as long as you're taking from one investment and putting into another, all you're doing is blending your portfolio, right? I get that question all the time. Should I borrow money from my 401k? Well, if you're using that, don't ever cash out your 401k because of the tax penalties and that sort of thing. But if you need $50,000 and you could turn that into another investment, all you're doing is again, making your portfolio a little bit more diverse. You can pay that back to yourself, through your payroll. And it gives you options then to get more cash flow in future, other products. So it really comes down to that how much cash do you have. Now, what's great these days is I get a lot of times these self-employed borrowers, and even before we go to the self-employed borrowers, if you are sitting on a lot of cash and you have a primary residence, whether you're self-employed or not, there's a great product out there right now called DSCR loans, which basically, not to bore you with the details, it's a very easy loan to qualify if you have good credit, a decent down payment. And all that has to happen is the rents have to cover what the mortgage payment is by 120 to 125%, right? So which is normal. You have the 25% occupancy rate, and you literally can get into a rental property with, doesn't matter what you show income-wise, doesn't matter if you're self-employed, doesn't matter if you're W-2'd. The only requirement is you have a primary residence now, okay? Because it is a true investment product. It's a great loan. We're doing those all over the country right now. The more you put down, obviously the lower the interest rate is. I normally say typically 25% down, just like a regular conforming multi, would be the minimum you would want to have in your head. If you can put a little bit more down, 30%, you really get basically the same rate that you would get today. Then as rates come down, hey, like we talk about, I can always refinance you at no closing costs. At that point, especially if you have those on there for 2 years, you're reporting that income. It's an easy way to increase cash flow, gain equity position. Well, rates are still high right now because don't forget, rents are still high right now. So you can qualify for that product now and not have to wait. Get in that position now so that way as interest rates come down, you're only going to gain more cash flow later.
Yep. I want to just go back to one thing you kind of hit on is, there's different ways. You don't just need like $200K sitting in a checking account, right? There's a lot of different ways to do this. You can partner. You can pull it from other places. If you've been sitting on a primary residence that's gone up in value, you could potentially do a HELOC. Again, you need to be responsible with all these decisions, but there's a lot of different ways to make it happen. I think too many people get stuck. They get in, they do the 5% down. That's great. At some point, you need money to invest in real estate, right? Like the gimmick can only go so long. So like you need to figure out that part. Whatever the angle is going to be, you need to figure it out. Like money is needed; it's a requirement,
Right.
and too many people get caught there.
And working with the right people, not only financial planners, your mortgage expert, your agents you work with on the real estate side, it's so important to grow your brand, let's say, or you personally, your net worth. People too much look at just one item, right? I don't want to touch my primary residence because it's my primary residence. That's not the proper way to look at it, because if you have 10 properties with $100,000 in equity, you have $1 million in equity. If you have one property paid off with $1 million in equity, you still have $1 million in equity. But these other 9 places are bringing rent every month. Guess what's going to happen 15 years from now? Let's say values stay exactly the same. Say values go down 5%. But you're going to keep that investment for the next 10, 15 years. You're going to pay down on that. You're going to have equity in all these different places. And one of my favorite facts, no matter during the housing crash, the Great Depression, I think there's never been a 20-year period where the average appreciation over that period has not been 4% per year. Sure, it's gone up 10% one year, down 15% another, up in our history. But over any 20-year period, it has always averaged a 4% return. So think about that.
Yeah.
So if you're into a long-term investment, you should have multiple properties.
Yep. What you mentioned some of the down payment requirements. What about just like rates compared to a primary residence? Similar, like give us a little bit idea.
Typically, I would say it's about, if you're putting 25% down, it's about 0.5% higher, and you will probably pay, about 1% more in fees. That's something you can negotiate into your contract also, as far as credits go. If you put 30% down or more, it's really only about 0.25% difference. Again, you might have a slight increase in fees, but not that bad. And people have this mindset that it's going to be so much more expensive on the loan side. That's why you get pre-approved, and that's why you run it. A lot of it is credit score based, okay? So the person with a 680 credit score compared to the 760 score, there's a big difference. Mm-hmm. Condo versus single family. Condos are expensive, guys. Condos are very Fannie and Freddie's eyes, and all these, even the 9QM lenders. You want a bigger down payment for condos because they're higher risk long-term to the servicers in their eyes. So that's why I love the multi-units. I love the 4 units. I love single families. I love those type of investment properties a little bit more than condos right now, especially in this market. But there's opportunities everywhere. If you're working with a good loan officer, shameless plug, happy to help. They should be giving you options at different down payment requirements, and also talking to you about what your long-term vision is and helping you get there.
Yep. One more tactical question. You talked about the rents, the DSCR loan, rents exceeding, your PITI and qualifying. Let's say you're buying something and rents are well below market. You're going to go in there and, you have a game plan to turn this thing around, whether it be value add, whether it be just raising rents, whatever it is. What do you get credit for, like market rate rent? Do you have to take, this guy's charging $1,000 and rent should be 14? Like how does that work? 'Cause that's a lot of buildings to buy.
So on the appraisal, we actually request a market analysis of rents in the area. Mm-hmm. And that is what we're going to qualify off of. So if something's, let's say you're buying a multi-unit property that is currently not rented out, we're still qualifying based upon what the market rents are going to be that the appraiser finds in that area of similar units. So that's not a problem. A lot of people think that's actually an opportunity in my mind, because if somebody's only getting $1,000 a month when they should be getting $1,500, they really don't know the market, which probably means they're going to underlist the house as well compared to the values of what it is.
Yep. Cool. Anything else?
That's it.
All right, let's wrap.
All right.
Who we playing for? Chicago Fact.
Playing for Dennis Richards. So Dennis, if myself or Chris gets this question right, you get a $50 gift card brought to you by Neighborhood Loans, Chris Pulio Group.
All right, so you had a football question last time. Now I'm going to hit you guys with a Schaumburg question. That's your neck of the woods over here. All right,
You enunciate Schaumburg.
Schaumburg. That's where my in-laws are from. What nature center and preserve in Schaumburg offers over 100 acres of hiking trails, wildlife viewing, and environmental education? Bussy Woods, Spring Valley Nature Center, Schaumburg Prairie Preserve, Will Trail Park.
It's either B or C. You take B, I'll take C. It's one of those.
Chris was much more confident on the football question.
Yes.
We're-
The Bussy doesn't.
It's not Bussy. I know that for sure.
'Cause that's Elk Grove.
It's a 2 or 3. I used to go here as a kid all the time. I love this place.
Okay, I'm gonna go B.
I'll go C.
All right, B it is. Spring Valley Nature Center.
Yeah, it's what I thought. It's right over there in Schaumburg, and it's right down the street here. Schaumburg.
So
and
the
I
Provo.
went
Bussy, the
B
Bussy one's the
because-
one that has like the elk there, right?
Yeah. That's
So-
at Arlington and Higgins.
Real 2-second funny story. When my kids were younger, I told them, "Hey, we're gonna go by Grandma and Grandpa's. We're gonna walk over there. We're gonna go see the elk." They thought I said elf, and they were pissed off when there was no magical elves in the forest. Instead, they were just things that looked like deer.
I used to tell them that it was a reindeer. That's why I used to tell them because it's so much cooler.
There you go.
And they're little.
Boom! Way to get the fact though.
All right, I knew it. I've been there. I used to love that place, so I'm happy. It's got that in-ground kind of built building there with the nature.
Yeah.
I love it. So, all right, Dennis, you get $50 gift card. Brought to you by Neighborhood Loans, the Chris Pulio Group. So, man, we got 2 questions in a row here so far. So
2 for 2.
I love it. So, all right, listeners. So, I've been to a bunch of networking events lately, and the talk in these events has been so much about off-market property. So, if you're looking to find deals or you can't find something on market, go to these networking groups. Check it out. There's a lot of I know of this. I got this pocket listed by realtors, all this type of stuff. So, go to straightupchicagoinvestor.com. We just updated all the real estate investor groups on there. Find one. If you see something on there that needs to be updated, let us know. Or if something that's missing, we could always add it. But yeah, get out there, get networking, and find some off-market properties. And Chris, thank you. Tom, thank you. Listeners, we will see you Thursday.
Thanks all.